Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Regional banks are the workhorses of African finance. While diversified banks capture headlines with their cross-border ambitions, regional banks serve the majority of African customers, hold the majority of household deposits in many countries, and deliver some of the highest returns on equity in global banking. This presentation examines the regional banking segment, focusing on national champions like Commercial International Bank of Egypt, Capitec of South Africa, Zenith Bank of Nigeria, Equity Bank of Kenya, and Bank of Kigali of Rwanda. We explore why regional banks outperform in many metrics, the structural advantages of single market focus, and the strategic choices that will determine their next decade. Leading regional banks span the continent. Commercial International Bank of Egypt is the largest with $42 billion in assets and dominates the Egyptian private sector banking market. Zenith Bank of Nigeria follows at $28 billion, the largest bank in West Africa by several metrics. Guaranty Trust Holding, also of Nigeria, holds $19 billion. KCB Group and Equity Bank anchor the Kenyan market with $12 and $11 billion respectively. Capitec Bank of South Africa has grown explosively to $14 billion and is now the largest bank by customer numbers in South Africa. Attijari Wafa Egypt and Bank of Kigali round out the regional champions. Together, these institutions hold more than $130 billion in assets. Regional banks share 5 defining characteristics. They have single market focus, with deep customer relationships and granular deposit franchises in their home country. They run a tighter product set, focusing on retail and commercial banking with limited investment banking or asset management capability. They deliver superior returns with average return on equity of 15 to 20%, significantly above diversified bank averages, driven by lower overhead and focused underwriting. They hold granular deposit franchises, with loan-to-deposit ratios typically below 80% and low-cost current and savings account deposits dominating funding. And they generate local currency earnings, which is both an advantage in stable markets and a risk in depreciating ones. In the 2023 financial year, leading regional banks delivered an average return on equity of 18.6%, materially above the diversified bank average of 14.2%. Net interest margins averaged 6.2%, with Nigerian banks at the high end due to high policy rates and South African banks at the low end due to competition. Cost-to-income ratios were a median 44%, with Capitec leading at approximately 36%. Non-performing loan ratios averaged 3.4%, slightly above diversified banks due to greater exposure to retail and small enterprise borrowers. Commercial International Bank, commonly known as CIB, is the dominant private sector bank in Egypt and the largest regional bank in Africa by total assets. With $42 billion in assets and a market capitalization exceeding $6 billion, CIB serves more than 800,000 retail customers and the majority of Egypt's top 1,000 corporate clients. Its performance in 2023 was exceptional. Return on equity exceeded 25% as Egyptian interest rates rose sharply, driving net interest income higher. CIB's challenge is navigating the Egyptian pound devaluation cycle while maintaining asset quality. Its opportunity is to capture the next wave of Egyptian financial inclusion, with approximately 30 million unbanked adults in the country. The Nigerian champions, Zenith Bank and Guaranty Trust Holding, deliver best-in-class returns from Lagos. Zenith Bank, with $28 billion in assets, is the largest bank in West Africa by several measures and consistently reports return on equity above 20%. Its corporate banking franchise is unrivaled in Nigeria, and its digital banking platform has gained significant traction. Guaranty Trust Holding, with $19 billion in assets, pioneered the holding company structure in Nigeria and has built a strong Pan-African footprint with subsidiaries in Côte d'Ivoire, Gambia, Ghana, Kenya, Liberia, Rwanda, Uganda, and the United Kingdom. Both banks navigated the 2023 Naira devaluation with discipline, delivering strong dollar-adjusted returns despite the currency shock. The East African champions Equity Bank and KCB Group anchor banking in Kenya and the broader East African community. Equity Bank, with $11 billion in assets, has built its franchise around small and micro-enterprise customers, with a strong digital banking platform called Equitel and a Pan-African footprint extending to Uganda, Tanzania, Rwanda, South Sudan, and the Democratic Republic of Congo. KCB Group, with $12 billion in assets, operates across Kenya, Tanzania, South Sudan, Uganda, Rwanda, and Burundi, and recently acquired Trust Bank of Rwanda to consolidate its East African leadership. Both banks deliver return on equity above 20% and have proven resilient through Kenyan macroeconomic cycles. Capitec Bank is the most instructive case study in African regional banking. Starting in 2001, Capitec re-engineered retail banking in South Africa with a single simplified product, transparent pricing, and branch and digital channels optimized for speed. It undercut incumbents on fees and captured the unbanked and underbanked market. By 2023, it had grown to 20 million customers, $14 billion in assets, and a market capitalization exceeding $18 billion United States dollars. The lesson for other regional banks is clear. Pick a customer segment, serve it better than anyone else, and avoid the temptation to add complexity. Specialist beats generalist in banking more often than not. 5 strategic imperatives will determine whether regional banks sustain their advantage. First, maintain cost discipline. The regional bank model is built on cost-to-income ratios in the low 40s or below, and drift above 50% erodes the model. Second, defend the deposit franchise. Granular low-cost deposits are the moat, and fintech competition for deposits must be met with competitive pricing and superior digital experience. Third, pursue selective cross-border expansion into 1 or 2 adjacent markets to diversify earnings without sacrificing focus, following the Equity Bank and KCB model. Fourth, embed finance. Partnering with telecoms, retailers, and gig platforms can extend reach without building branches. Fifth, build currency hedging capacity. Where possible, generate fee income in stable currencies to offset local currency depreciation pressure on dollar earnings. In summary, regional banks will continue to outperform diversified banks on return on equity, driven by cost discipline and customer focus. Cross-border expansion into 1 or 2 adjacent markets will be the primary growth vector for the next 5 years. Embedded finance partnerships with telecoms and retailers will redefine customer acquisition economics. And currency risk management will increasingly differentiate winners from losers in depreciating markets. The regional banking segment will remain the most profitable corner of African finance, and the most attractive for investors seeking structural growth. Thank you for watching this examination of regional banks.